U.S. government shutdown follow-up, what it means for the economy, and what happens next. If you woke up this week wondering why flights are delayed, economic data is going dark, and markets feel twitchy, it's not your imagination. The United States federal government has been partially shut down since October 1st, 2025, after Congress failed to pass new funding for the fiscal year. We're now in week 2, and pressure points are multiplying, from missed paychecks to airport staffing and delayed economic releases. Today I'll break down what's really happening, who's hurt first, what it means for GDP, inflation, and markets, and most importantly, the most likely outcomes over the next few weeks. Stay to the end. I'll give you 3 scenarios with probabilities and the investor playbook for each. Here's the headline risk. Each additional week of shutdown shaves measurable growth off the economy, delays key data the Fed watches, and tightens financial conditions through confidence channels, not just government spending. Independent estimates peg the cost in the billions per week, and jobless claims are already ticking up as contractors and affected sectors adjust. Meanwhile, a very public fight in Washington over whether furloughed workers are guaranteed back pay has injected legal uncertainty and hit morale across the federal workforce. What exactly shut down? The facts. At 12:01 a.m. EDT on October 1st, 2025, the federal government entered a funding lapse. Essential services continue: military operations, air traffic control, border protection, Social Security, and Medicare benefits processing, but large parts of the civilian workforce are either working without pay or furloughed. The shutdown stems from partisan disagreements over spending levels and policy riders, including health insurance subsidies and related budget items for FY 2026. Scale of impact: hundreds of thousands of civilian employees are furloughed, while others are accepted and must work without immediate pay. The first missed or reduced pay cycles start to hit across agencies around October 10th, 14, with the military's next pay date on October 15th at risk if no resolution emerges. Contractors, unlike federal employees, aren't guaranteed back pay, which magnifies the private sector spillovers. Air travel and public-facing operations. Airport operations remain open, but stress is visible. TSA officers and air traffic controllers must report without pay, increasing absenteeism risk and compounding delays. This mirrors patterns seen in past shutdowns and is now visible across major hubs, an acute pain point that raises political pressure quickly. National parks and local economies. Many park facilities scale down to skeleton staffing, though some sites are temporarily kept open with local or state funding to protect tourism revenues. Great Smoky Mountains. National Park is a current example. This is a direct channel to small businesses that rely on steady visitor flows. Why this shutdown is uniquely disruptive? 1. Data blackout risk. During shutdowns, agencies like the Bureau of Labor Statistics and Bureau of Economic Analysis pause key publications. That means jobs reports, CPI, retail sales, and GDP updates can be postponed, leaving the Fed and markets to steer partly blind. In 2019, delays complicated monetary policy assessments. This time, the stakes are similar because inflation, progress, and growth resilience remain finely balanced. Early signs this week include delayed federal releases and heavier reliance on state-level series like jobless claims. 2. Back pay ambiguity and why it matters. Historically, Congress has guaranteed retroactive pay. In 2019, lawmakers passed the Government Employee Fair Treatment Act, widely interpreted to guarantee back pay after shutdowns. This week, however, debate over whether furloughed workers are automatically entitled to it has spurred backlash from legal experts, unions, and members of both parties. Leadership has signaled Congress would provide back pay, but conflicting messages feed uncertainty and anxiety among federal workers. Morale and spending decisions suffer in real time when families aren't sure if a check will ever come. 3. Airport and logistics choke points. Shutdown dynamics squeeze staffing at FAA and TSA, generating cascading travel delays that hit business productivity, tourism, and time-sensitive logistics. It doesn't take a full stop to hurt GDP. Friction adds up. That's why aviation disruptions often become political forcing mechanisms to end shutdowns. 4. Confidence channels and contractors. Even when essential operations continue, purchases, grants, permits, and routine payments often pause. Federal contractors, who lack guaranteed back pay, frequently lay off or furlough staff quickly. That bleeds into local economies, especially in Washington, D.C., Northern Virginia, Maryland, and defense-heavy regions. How big is the economic hit? Let's anchor on 3 reference points: current 2025 estimates, the Congressional Budget Office, CBO, and history. Current week estimates. Recent analyses suggest each week of shutdown could trim around 0.1 percentage point off annualized GDP growth and cost billions in activity as worker income, procurement, and confidence fall. One estimate puts the cost at about $7 billion per week. Some White House figures circulated to media floated up to $15 billion per week, with 43,000 potential additional unemployed if the shutdown stretched to a month, and consumer spending down by roughly $30 billion. The exact hit depends on duration and how much delayed activity is recouped later. Jobless claims signal. Initial claims, a real-time barometer, have already ticked up, and analysts attribute part of that to early shutdown effects, particularly among contractors and affected service sectors. States continue to report these data even when federal publication schedules are disrupted, making claims a critical still-on indicator in a shutdown. CBO framework and history. The CBO notes that direct losses from shutdowns often rebound once government reopens. Think delayed paychecks and deferred services that later resume. However, some output is permanently lost, and shutdowns reduce GDP in the quarter of occurrence. For example, the 2013 shutdown cut Q4 growth by around 0.3 percentage points. And the 2018-19 shutdown caused a temporary drag with some unrecoverable output even after back pay. The 2025 CBO brief reiterates those channels: lost federal compensation during the lapse, reduced purchasing, and indirect effects like permits and loans not processed on time. Inflation and the Fed. A shutdown doesn't by itself create inflation. If anything, the immediate effect leans disinflationary by dragging demand. But there are nuances. Air travel disruptions can temporarily raise airfare. Data delays create policy uncertainty, potentially making the Fed more cautious about big moves while waiting for clarity. And if the shutdown dents confidence and hiring, it can loosen labor markets modestly, consistent with the slight rise in claims. Net-net, modest downward pressure on growth, ambiguous near-term impact on inflation, and higher uncertainty, which tightens financial conditions on its own. Politics and path to resolution. Where negotiations stand. As of today, the Senate has repeatedly failed to advance bills to reopen the government. Votes have stalled, and adjournments imply the shutdown will extend into next week unless there's a breakthrough. Leadership messaging indicates no formal comprehensive talks are underway, though quiet conversations are reportedly occurring. Polling shows blame is broadly shared by the public, which complicates political calculus and limits easy win-lose narratives. Key policy friction points. Disagreements over spending levels, foreign aid rescissions, and health insurance subsidies have been central. Meanwhile, the administration has escalated public communications, including airport-focused messaging, amplifying partisan pressure, but not necessarily moving votes. Historically, shutdowns end when a visible pain threshold is crossed. Missed military pay, airport chaos, or a market wobble that scares both sides into a short-term patch, a continuing resolution, or CR. Forcing dates over the next 2 weeks. Watch pay cycles, October 10th, 15, airport staffing trends, and any market reaction. Also watch whether Senate leaders float a shorter CR, 2 to 4 weeks, as a face-saving way to reopen while negotiations continue, a pattern seen in prior episodes. Deadline clusters around mid-month could concentrate pressure. Sector by sector, who gets hit first? 1. Federal workforce and adjacent services. Obvious first-order impact, lost pay, temporarily, reduced discretionary spending by affected households, and cutbacks at local businesses near large federal installations. Legal uncertainty over back pay has amplified stress, even as congressional leaders signal intent to make workers whole. Contractors remain the weak link with no guarantee of back pay. Expect outsized layoffs and cash flow strain in small and mid-size vendors. 2. Travel and tourism. TSA, FAA, staffing pressures and park closures hit airlines, hotels, restaurants, and attractions, especially in gateway cities and park-centric towns. Local stopgaps, like funding parks from city-county budgets, reduce damage but aren't universal or indefinite. 3. Housing and finance. Mortgage and housing activity depends in part on federal verifications and guarantees, for example, FHA VA processing. Prolonged shutdowns slow pipelines, extend rate locks, and create tail risk for pending closings. 4. Healthcare and research. Agencies like NIH and CDC scale back non-essential operations. Grant reviews and new awards stall, impacting labs and universities. This creates multi-quarter ripple effects if the shutdown lasts, as research timelines are hard to compress. 5. Agriculture and small business. USDA and SBA functions, including certain loans and grants, slow or halt, delaying expansions and equipment purchases in farming and small business ecosystems. Markets, what to watch? Historically, markets don't panic on day one of a shutdown because investors assume a CR will arrive. The risk comes if closure lingers and data darkness collides with other macro shocks. 3 watch items. 1. Treasury market functioning and term premium. Fiscal stalemates can nudge the term premium higher if investors perceive policy dysfunction, raising long-dated yields even without new data. 2. Airline and travel equities, sensitive to TSA, FAA bottlenecks and traveler sentiment. Disruptions can show up in load factors and yield management quickly. 3. Defense and contractors. Prime contractors usually weather short shutdowns. Smaller subcontractors suffer faster. Prolonged stoppages strain working capital and can widen credit spreads for weaker names. For broad indices, the base case is range-bound chop unless shutdown risks intersect with a hot CPI print, earnings disappointments, or a sharp move in real yields. The next few weeks, 3 scenarios and probabilities. These are forward-looking assessments. My analysis, not certainties. I'm weighting scenarios based on the political calendar, economic pressure points, and historical behavior in prior shutdowns. Scenario A, short CR breakthrough, probability 50%. What happens? Mounting pressure from missed pay, airport delays, and negative polling drives Senate leaders to cut a short continuing resolution, 2 to 4 weeks, reopening government while they negotiate larger issues. Catalysts, military pay date, October 15th, weekend airport disruptions, and moderates in both parties insisting on a timeout. Economic impact. If resolved within the next 7-14 days, GDP hit is modest and largely recovered in Q4/Q1 per CBO dynamics. Some permanent losses remain, contractor work not made up, travel not rebooked, but the macro picture stabilizes. Markets breathe a sigh of relief. Treasury yields ease a touch on lower policy uncertainty premium. Investor stance. Stay diversified, avoid panic selling. For opportunists, watch travel names into resolution. Consider quality small caps exposed to federal spend that sold off unfairly. Scenario B, stalemate into late October, probability 35%. What happens? Messaging war escalates. No formal negotiations materialize. Senate holds symbolic votes. The eventual deal still looks like a CR, but extracted under duress and with face-saving concessions on both sides. Economic impact. 2 to 3 weeks of shutdown could shave 0.20.3 pp off annualized quarterly growth and $14 to $21 billion in activity, some of which returns later, but not all. Consumer sentiment softens. Small biz surveys dip. Investor stance. Expect volatility spikes, but not necessarily a bear market trigger. Emphasize quality balance sheets, free cash flow durability, and defensives that weather confidence shocks. Keep dry powder for dislocations. Scenario C, prolonged confrontation, probability 15%. What happens? The fight expands, riders harden, airport strain and data blackout become the new normal. Credit spreads for smaller contractors widen. Talk of piecemeal agency funding emerges as a patchwork while core disagreements persist. Economic impact. A month-plus shutdown risks tangible labor market damage, contractor layoffs that don't reverse, deeper consumer spending pullbacks, and potentially a risk-off move in equities if combined with other macro shocks. Multi-week losses could reach into the tens of billions with higher unemployment, large enough to dent full-year GDP. Investor stance. Raise quality, reduce cyclical beta, and protect liquidity. Consider short duration on the fixed income side if term premium spikes. Selectively add gold or defensive hedges on drawdowns, sizing prudently. Why a short CR is still the base case. Past shutdowns typically end not with one side winning, but when a symbolic line is crossed, military pay at risk, airport chaos, or a market wobble. We already have 2 of the 3. Polling suggests voters blame both parties, removing a clear political incentive to hold out indefinitely. Senate adjournments without a breakthrough keep pressure rising. and airport-focused messaging by the administration highlights the very pain point most likely to force a deal. A short CR preserves leverage for the next round while relieving immediate pressure, hence the base case waiting. What this means for the Fed? The Fed's challenge during shutdowns is data scarcity. If CPI or jobs reports are delayed, officials lean on high-frequency proxies, jobless claims, card spending trackers, and surveys. A short shutdown likely doesn't change the policy path. A longer one that dents demand could nudge expectations slightly more dovish at the margin. But a shutdown is not stimulus, it's fiscal friction, so the Fed won't cheer it. The main effect is uncertainty and signal noise, not a directional macro reset. The investor playbook. 1. Time horizon discipline. If your horizon is multi-year, don't let a 1 to 3 week policy event derail your plan. Shutdowns are temporary, even if noisy. 2. Liquidity and credit checks. If you own small-cap contractors or suppliers dependent on federal flows, review cash buffers and debt maturities. Be realistic about receivables in a prolonged scenario. 3. Watch the travel tape. High-frequency tells, TSA throughput, flight delay trackers will signal if aviation pressure is worsening or easing. Resolution often produces a snapback in travel-adjacent names. 4. Quality tilt. In uncertainty, balance sheet strength and free cash flow matter more. This isn't about hiding, it's about owning optionality to buy the dip when the CR lands. 5. Macro hedges sized sanely. If term premium flares, short duration can cushion fixed income portfolios. Modest allocations to gold or volatility hedges can help, but avoid over-engineering. The human angle! Behind the macro charts are families without paychecks weighing rent, childcare, and groceries. Even if back pay arrives later, missed payments and late fees are real, and contractors may not be made whole at all. Uncertainty around back pay has heightened stress, though congressional leadership has publicly pledged to make workers whole. In practical terms, stress today lowers spending today, and that shows up in the data tomorrow. The bottom line and near-term expectations. We're entering week 2 of the shutdown. Senate votes have failed repeatedly, and adjournment signals no immediate deal. Expect the shutdown to extend into next week. Economic drag builds with time. Think $7 billion plus per week and 0.1 pp off growth, partially reversed upon reopening. Losses mount if it drags into late October. Jobless claims are already edging up, a canary for broader labor softening if this persists. Back pay remains a political legal flashpoint. Precedent and bipartisan signals point to retroactive pay once a deal lands. Base case, a short CR within 1 to 2 weeks driven by missed pay cycles and aviation pressure. If wrong and it drags, expect higher market volatility and a larger Q4 growth dent. Conclusion: if you found this breakdown useful, hit like so more investors see it. Drop a comment. How are you positioning through this? And if you want my Sunday note with scenario trackers, jobless claims, TSA throughput, and Senate vote count, subscribe with the link in the description. Don't forget to like, share, and subscribe, because the truth deserves to be louder than the lies. Stay awake! Stay aware! This is Felix. See you next time!